Bitcoin stands still at $74 as fear gathers before the Fed. Bitcoin is not exploding. It is waiting, and that is the part traders hate most. The price holds near $74,000, volume thins, and the market suddenly remembers that stillness can be louder than momentum. We are watching a pause with teeth. After the surge toward $76,000, Bitcoin has cooled into consolidation, and beneath that calm you can feel the change in posture. Longs have taken profit, shorts who were forced out are not rushing back in. Everyone is pretending to be patient, which usually means everyone is quietly measuring risk again. It celebrates the breakout, then stares at the ceiling it just created. It wants certainty from a world that trades in uncertainty. And right now, with the Federal Reserve meeting ahead, uncertainty is exactly what has returned to center stage. You see the pattern already, don't you? When price jumps fast, traders imagine acceleration. When price slows down, they call it health. Both stories can be true at once. The difference is time preference. The impatient want a straight line to $80,000. Reality prefers a stair. We are not looking at weakness alone. We are looking at digestion. After a violent move upward, markets often need to absorb their own enthusiasm before they can continue higher. That is what consolidation really means. Not defeat, but assimilation. The market must decide whether yesterday's buyers were conviction or merely momentum tourists passing through. And still, the volume tells its own quiet story. A 33% drop in daily trading activity says participation has cooled even while price remains elevated. That matters more than headlines admit. Price can float on memory for a while after volume fades, but memory does not build support forever. What traders call holding steady is often just uncertainty wearing clean clothes. The broader backdrop makes this even more interesting. Gold is quieter too. Silver has lost some of its urgency. Crude oil has stopped behaving like it wants to sprint without permission from geopolitics first. Volatility across commodities has retreated enough to suggest one thing. Markets are no longer pricing pure panic, but neither are they pricing peace. That matters because fear does not vanish when it becomes less noisy. It simply spreads out and becomes more intelligent. The war in Iran continues to keep risk appetite incomplete, which is a polite way of saying capital refuses to commit fully while the map remains unstewed. Traders may love narratives of growth and breakout candles, but capital itself is less romantic. Capital asks whether tomorrow will still look like today before it risks becoming tomorrow's liquidity for someone else. And then we come to equities, because yes, even here the old machine keeps grinding upward as if gravity were a theoretical concern rather than an AC. Counting fact. NASDAQ 100 futures are higher. The S&P 500 is higher. The tone in stocks remains constructive enough to keep optimism alive. But optimism under central planning always comes with fine print, microhook. What happens when every market waits for one institution to speak? That is where we are now, not at certainty, at ritual. The Federal Reserve meeting hangs over everything like a judge who will almost certainly do nothing and still move billions by speaking carefully anew. The edges of inflation and employment data to make everyone infer meaning from tone instead of act. A pause in rates appears nearly guaranteed, and yet we know better than to mistake no change for no consequence. Inflation pressures have been disturbed by oil's rise. Jobs data have softened. The economy offers contradictions on both sides of the room. That means Powell's press conference becomes less about policy mechanics and more about signaling discipline inside ambiguity, which is exactly how ambiguity, modern monetary authority, works when it cannot openly admit how little precision it actually possesses. We should be honest about this. Central banks do not eliminate uncertainty. They curate it. They redistribute it through language. They turn economic fragility into forward guidance and call that stability. So when traders grow cautious ahead of such a meeting, they are not being irrational. They are responding correctly to an environment where one statement can reprice risk across assets that were already leaning on fragile assumption. Bitcoin feels this immediately because Bitcoin lives where monetary confidence ends. It does not care about speech. It cares about liquidity conditions, time preference, leverage cleanup, and whether humans still believe borrowed money should outrun reality forever. And right now, leverage appears tired. That exhaustion shows up first in derivatives, positioning, those crowded expressions of conviction built on borrowed certainty rather than owned conviction. When longs take profits after a sharp move and shorts stay sidelined instead of aggressively reloading, what you get is not panic, but hesitation. Hesitation can be far more important than fear, because hesitation delays commitment before volatility expands again. This is why so many breakout calls fail emotionally, even when they remain technically plausible. The chart may say continuation. The trader says wait. Between those two impulses lies the entire psychology of speculative markets. Markets do not move only because information changes. They move because willingness changes, and willingness right now looks selective everywhere we look. Stocks remain bid enough to suggest residual confidence. Commodities whisper caution instead of screaming crisis. Bitcoin consolidates near new ground, while participants decide whether this level deserves respect or merely attention. That distinction matters enormously here because support zones are never just numbers. They are agreements under pressure. A support level becomes real only when enough participants behave as if losing it would matter. Until then, it is just ink on a chart waiting for emotional validation. There was enthusiasm when $72,000 gave way. There was talk of an immediate path toward $80,000. But markets rarely reward consensus with speed once consensus becomes obvious enough to be crowded into positioning flows rather than conviction flows. This is where greed meets structure and discovers structure has no interest in flattering greed's timeline. We should also notice something subtler. Bitcoin's recent calm does not look like apathy from above. It looks like selective restraint from within market microstructure itself. When volatility compresses after expansion, participants often interpret that as boredom or weakness because human attention craves visible motion as proof of life. But compression frequently precedes translation. One direction eventually absorbs all the stored tension that silence allowed to accumulate. Another microhook is calm here a floor or just the inhale before impact. We cannot know yet which side wins until external catalysts force commitment from traders who have been waiting for permission all along. That catalyst may come from Powell's tone more than his decision itself, since decisions without surprise often matter less than interpretation under stress conditions already prepared by inflation anxiety and weakening labor data concern. This is why macro matters, even when Bitcoin pretends otherwise during especially self-confident periods online. Bitcoin trades globally against human expectations about money itself, and money expectations always sit inside macro conditions, whether maximalists want them there or not. Rates, liquidity, credit appetite, real yields, risk premia, confidence in institutions, and above all trust in whether nominal returns will outrun real erosion long enough for people to feel clever before they feel poor again later on. Paper terms nobody noticed until too late. Yes, the sentence gets long there, because so does history when people insist on ignoring monetary causality until consequences arrive wearing expensive shoes. And here lies one of Bitcoin's great truths. It does not need perfect conditions. It needs honest ones. Honesty brings volatility first, then clarity, then repricing, and only after that do crowds begin calling wisdom what was actually just delayed recognition as we watch this latest consolidation unfold near $74. We should resist two lazy interpretations at once. The first says Bitcoin must immediately rip higher because momentum exists. Yesterday, the second says, slowing proves exhaustion. Both miss the deeper point. Bitcoin often pauses hardest where legacy minds would expect exuberance. because its advance reflects adoption layered over skepticism, rather than pure speculative oxygen. Each new leg up must digest prior disbelief. Each paw use forces latecomers either into discipline or out into irrelevance. That process feels dull, while occurring live and sacred only afterward. Meanwhile, equities continue edging upward, as if investors have decided growth deserves another chance, despite all visible frictions in policy and geopolitics. At bid supports risk sentiment broadly, but does not erase caution underneath it, simply hides caution inside diversification stories people tell themselves. LVS so they can remain invested without admitting they are nervous. We know this dance well. Stocks rise, headlines soften fear, crypto stabilizes, and suddenly everyone acts as though macro tension were merely background noise rather than active architecture. It never disappears, though it waits in us. Breeds in funding rates and option premiums. In conversations about inflation that refuse clean resolution, in labor softness that complicates rate reto. Rick and energy shocks that remind everyone how quickly transitory becomes expensive vocabulary again if oil stays elevated long enough. Inflation stops as being academic and starts becoming political again, and politics always finds its way back into asset prices, because asset prices are simply future arguments discounted into present form. So what should we actually see here? Not panic. Too easy. Not euphoria. Too early. We should see preparation. Preparation looks quiet from afar. Lower volume, narrower ranges, cautious par. Anticipation, selective buying, less leverage, enthusiasm, more waiting. But inside that quiet, there is real work happening as traders reposition around a future nobody can price perfectly until central bankers speak their half-truths aloud. This kind of market rewards patience far more than prediction. Prediction tries to own outcome. Patience survives outcome, and survival matters because many participants confuse being right once with having understood. But anything durable at all, think about how fragile confidence becomes when multiple asset classes pause together. Bitcoin stalls near highs. Commodity as cool. Equities keep grinding. Fed uncertainty looms. Inflation stays sticky. Jobs weaken. Geopolitics refuse closure. What you get is an environment where every group sees only part of the picture and therefore extrapolates its own comfort zone, as if comfort were analysis. It isn't. It never was. PR. ICE action exposes this beautifully. A strong rally followed by measured consolidation usually forces two kinds of players out: the ones who entered a lane, chasing velocity, and the ones who shorted too early, believing gravity would rescue them quickly. Both groups become spectators, and spectators eventually become liquidity for whoever remained disciplined enough to wait through noise without worshipping every candle. That discipline may now belong up increasingly to those who understand Bitcoin less as entertainment and more as monetary logic, under stress when rate cuts become uncertain or pauses too are symbolic rather than supportive. Hard assets regain their philosophical edge, not because algorithms learned virtue, because debasement keeps doing debasement always does, quietly taxing time itself. If you hold something scarce through such periods, you do not merely speculate on price, you express confidence that reality will eventually prefer what cannot be printed over what must constantly be defended by policy language. There it is again. Human action revealing itself through markets. No slogans needed, only incentives, and incentives right now say caution first. The post-Fed atmosphere may therefore matter less for whether rates move today and more for how language reshapes expectations around summer positioning across crypto and equity. A calm statement could embolden buyers if interpreted as dovish restraint against softening growth data. A firmer tone could cool speculative appetite if inflation concerns remain dominant despite weaker labor prints. Either way, volatility returns eventually because silence never lasts inside leverage systems whose participants mistake temporary stability for structural safety. Maybe that's why Bitcoin fascinates us so much during moments Like this, it refuses emotional theater while everybody else performs certainty before microphones. It sits there between belief systems, not asking permission, not apologizing, just waiting for humans to reveal how much truth they can afford today. We should also remember something uncomfortable. When aiding gets cautious near important levels, the crowd tends to search outward for explanations first. War headlines, Fed commentary, oil spikes, macro surprises. But often the deepest reason sits inside position management itself. If everyone bought breakouts expecting instant continuation, then any delay creates natural friction. If shorts were forced out violently, then their absence removes fuel from immediate follow-through. If profit-taking vests faster than fresh demand, then price must consolidate until new conviction replaces old excitement. This sounds technical because markets dress in still ink and jargon, but underneath every indicator lives one primitive truth. People hesitate when outcomes become expensive. Expensive mistakes create quiet. Books quiet. Books create sharper future moves. Sharper future moves attract new narratives retroactively assigned brilliance by observers who are arrived late enough to think cause follows effect. So, yes, we wait around $74 now with subdued volatility shadowing broader uncertainty. And yes, perhaps another expansion leg comes soon. If support holds and macro noise fails to dent risk demand further. But what matters most today is not fantasy about exact targets. What matters is structure. Structure says Bitcoin remains elevated after breaking higher. Structure says volume has cooled, but interest has not vanished. Structure says derivatives players have become less aggressive. Structure says macro catalysts still hold power over sentiment. Structure says markets across assets are pausing together rather than diverging wildly when several major markets breathe at once instead of sprinting independently. You learn something important. Capital isn't fleeing. Capital is evaluating. Evaluation precedes commitment, and commitment only arrives after due. UBTT has spent itself honestly. This may sound unglamorous compared with moonshot fantasies or doom-laden collapse stories, yet reality usually arrives earring neither costume. Reality arrives, measured then sudden, so we sit with this image. Bitcoin resting above recently conquered ground, traders glancing on toward Washington, oil keeping inflation alive just enough, stocks trying on resilience, volatility lowering its voice without disappearing. System standing still, only long enough for hidden pressure to gather beneath polished surfaces. That pressure will choose expression soon enough undone. Till then we watch what cautious hands do around support, rather than listening too closely to reckless mouths around resistance, because prices tell us where belief ended yesterday, and volumes tell us whether belief returned today. At this stage, Bitcoin offers neither surrender nor triumph, only evidence. Hence evidence that scarcity still commands attention when money grows uncertain, evidence that patience beats performance theater whenever institutions rehearse control over unstable conditions, evidence that every supposedly neutral pause contains information if you know how human beings behave when seeking consequences. Approach slowly first and quickly later. Maybe tomorrow breaks higher, maybe Powell cools sentiment briefly before risk reasserts itself. Maybe sellers discover there was less strength here than hoped, or maybe this quiet shelf becomes exactly what strong trends need before continuing upward. With fewer passengers and cleaner hands, either way we learn again that markets do not reward fantasy forever. They reward recognition, and recognition usually comes after silence has already done its work. So let us stay with the silence a moment longer, because sometimes the loudest thing in finance there's nothing moving where everyone expected everything else. What changed wasn't just price, it was willingness, and once willingness shifts under your feet, what part of your certainty was ever truly yours?